Are capital markets standing at the intersection of hope and fear? As we'd hoped for rate cuts, that didn't happen. And the fear is what's next as we get closer to the next Fed meeting. When looking at a specific part of the fixed income asset class, muni bonds have certainly seen the biggest sales boom since at least 2013. Question is why? And depending on the Fed's actions this year, will it have an impact on muni performance? We're going to get into that right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for being with us today. I'm going to talk about munis today with my colleague from AB, Matt Norton, CIO of Municipal Bonds. Matt, great to have you here. It's a really, really interesting and good time to be talking about munis, as we were alluding to before we even started today, and our own CIO here, our muni team, also agrees with that. So I want to start with the Fed, though. There's been a lot of speculation about what the Fed may or may not do this year. It looks like we're going to get probably one rate cut, maybe two, but there's still a little too early to tell. The next Fed meeting is coming up very soon. What are your thoughts on the Fed's actions this year?
We think the Fed is going to do what they've kind of talked about. They said they're going to be data dependent because right now they don't want to rock the boat. Before, they'd kind of indicated that they were going to be cutting rates more aggressively than ultimately what came to fruition because the economy kept being very strong. Inflation was coming in higher than expected. So then they had to kind of walk things back. And now I really think their whole thing is going to be, let's not rock the boat. Let's be data dependent. Let's tell the whole market that we're basically going to keep rates here until the data tells us that we can pivot. And ultimately, we think that's what they should be doing. We think that the Fed will have to cut rates probably sometime by the end of the year, probably one cut. We do think it's higher for longer, not higher forever. And we do think there's a lot of things in the economy that are showing that ultimately the lagged effects of monetary policy are working, but they're working with a lag.
Right. Yeah, I mean, and you know, Powell keeps alluding to the fact that we're not quite close or even on approach to getting to that 2% target that the Fed has for inflation. So obviously we're going to have to look at a couple more months of numbers, especially when it comes to CPI and the jobs numbers. So clearly what we thought at the beginning of the year, which might have been 4 to 5 rate cuts, has lessened. Here we are sitting in the middle of the year. A lot has changed. So let's focus now on why we want to talk to you today, which is about opportunities within the municipal bond market. It's the highest issuance of munis in over a decade. I mean, it's been a really fabulous time for muni investors and for the muni markets in general. So where are you seeing right now opportunities within municipal bonds?
I think municipal credit is a big opportunity right now. So what's happened over the last couple of years, muni spreads have widened. They've gotten wider than they were prior to when the Fed started raising rates in 2022. So you have credit spreads that are wider. At the same time, the credit fundamentals in the municipal market are still really, really strong. You basically have rainy day funds for state and local governments near all-time highs. At the same time, issuance has been a little bit higher in the muni market this year, but we don't think credit issuance is going to be very high go forward. We think a lot of that issuance was pulled forward because of the election, and that's part of the reason that a lot of the issuance was much higher this year. But when you think about muni credit, basically you have wider than average valuations, you have credit fundamentals that are really, really strong, and go forward issuance shouldn't be that high. I don't think there's many things, not just in munis, but in financial markets that have that kind of setup right now.
Yeah. How much do you think that the performance that we've seen, because it's been pretty strong since the start of 2024, how much of that is tied to the Fed, or is it tied to the Fed at all? What's the correlation between where the Fed is pointing to and how munis have been performing?
Yeah, I think munis, if you look at just munis as an asset class, the performance of the index has been higher than taxable bond indices. I think some of that is just the fact that when interest rates go up, muni interest rates go up less because investors care about after-tax yield changes. They don't care about pre-tax yield changes. So munis act with a little bit lower beta. But particularly in credit, I think what's happened is, some people are looking at the high interest rates that we have right now. They want to lock in these higher rates for longer. They're starting to think about, let's roll out of some of that $6 trillion that's sitting in money money markets and try to lock in higher yields for longer. And with municipal credit spreads as wide as they were and as wide as they are, that's a really good way to lock in extra yield for longer.
Spreads are tightening, though, a little bit right now on the credit side, aren't they?
Absolutely, yeah, because I think people are starting to come back in. They're trying to lock in these higher yields, and you are seeing spread tightening. That's driven really good performance from muni credit, but you're still a long way to go until you get back to where you were at the beginning of 2022 or even longer term averages.
Right. So what would you say to an investor, what you'd be avoiding maybe now within the space if you had something to pick there?
Yeah, the biggest thing I would avoid, I'd be really thinking about the yield curve, because the municipal yield curve still looks like a U shape or almost like a Nike swoosh, where you get higher yields on the front, you get higher yields on the back end, but then the middle of the yield curve has basically this gully. And why does that exist? That exists because a lot of flows in the last couple of years have been going from basically going into passive type strategies, 1 to 10 year ladders. It doesn't matter what the 10-year part of the curve or the 8-year part of the curve looks like if you're going into 1 to 10 year ladder. A portfolio manager has to buy that part of the curve because it's part of the mandate.
Right.
And so what we think is likely to happen is, again, some of that $6 trillion, once that tries to come out and starts, people get more confident that the Fed's likely to cut. We think that people are going to look at the muni market. They're going to say, well, I can buy a 1 and 20-year bond, get a much higher yield than buying the same average maturity in that gully. And we think that a lot of that money is probably going to go into more active type higher quality strategies or strategies that have a lot of flexibility that have higher yields. And so we do think ultimately, one, investors when they roll out of cash are going to get a higher yield by barbelling their structure. And then two, they're going to get better price performance as the curve normalizes because we think that intermediate part of the curve is likely to underperform.
Right. I mean, and there's always a risk with long duration, isn't there? I mean, even though you're looking at 30 years at 3.6 or 3.7, but there's more risk the longer out you go out the curve.
Oh, no doubt about it.
Right.
Yeah, no, exactly. So a lot of it depends on investment horizon. A lot of it depends on risk tolerance. You definitely get higher yields for going out the curve, but that certainly comes along with volatility.
Right, exactly. Like we always say on these shows, there's nothing you do in the investing world that doesn't come with some type of risk, and that's why we always recommend our viewers talk to their financial advisors because they are the experts in the space, right? So as we're wrapping up here, Matt, how is AB, how you and your team, how are you positioning muni bonds right now in a portfolio, especially when you're talking to people like our advisors and our clients?
Yeah, so when we look across our entire platform, there's a couple key themes. One, since we do think that the general trend of interest rates is lower, we think that investors should tilt a little bit longer duration than their long-term average. So we're not saying make big duration calls, but you should be tilting a little bit longer, try to lock in yields for longer, higher yields for longer.
And that's to get out of that belly of the curve that you were talking about earlier.
Exactly,
right?
Exactly. Yep, absolutely. And when we look at economic data, we do see nominal GDP has come back to more normal levels. Bank lending growth has slowed dramatically. We do think that the monetary policy is ultimately working, although slowly. So being a little bit longer duration. Barbelling that maturity structure, buying those short and longer bonds, get the same average maturity, but ultimately be able to get a higher yield and lower volatility. That makes a lot of sense. Owning credit, we talked about credit being really attractive. That makes a lot of sense to us as well. And just being very flexible. The muni market has 1 million CUSIPs, 50,000 issuers. You might see 70,000 bonds available to buy on any given day. That type of inefficiency allows flexible managers to be able to take advantage of the inefficiencies in the muni market. So we think that's very important. And the other thing that we're really thinking about in the market today is that different types of investors might have different objectives. And so, the same type of strategy might not be the right strategy for everybody, as you were talking about earlier. So if you're an investor that really is sensitive to inflation because you're very fixed income heavy, there's tax efficient ways to hedge against inflation. If you're just trying to get out of cash, maybe a more shorter duration strategy might make sense. So some of it absolutely depends on what your investment objective is.
Absolutely, like your risk profile and all that, and especially even your time horizon has a lot to do with that as we're talking about duration here. Matt, thanks very much. Good to have you join us in the studio.
Absolutely, thanks for having me.
Great, Matt Norton, CIO of Municipal Bonds at AB. Thanks to our partners there at AB as well. And for more information, please visit our website, our insights page at ubs.com/views. Plus, you can follow us on social media. We're on all the major platforms, including Instagram. Give us a follow at UBS Trending. Lots of studios content there that you're not going to find anywhere else. And as always, as Matt and I both mentioned, make sure you are having a conversation with your financial advisor, especially on topics like these. Until next time, I'm Anthony Pastore. Wish you a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.